Hello folks, welcome back to another Smart Simple Savings. In this video we're going to continue our conversations on winning big in 2023. If you watched my last video, all 5 of you, that was on setting up your budget so you can pay off the most debt, you can save the most money, and meet your financial goals for 2023. And today we're going to talk about retirement accounts. First, we're going to go through some of the changes that are happening in 2023 as far as contribution limits and things like that. But we're going to spend a big chunk understanding how to invest in our 401k, how to invest in our Roth, so we can maximize the returns in those accounts. And then we also know what's happening. We know what we've invested in. So a lot of the retirement accounts that are available to us all increase their contribution limits into 2023. So for the 401k and the 403b, the contribution limit was at $20,500. They've increased it up $2,000 for the year, so now you're at $22,500. Now, if you are 50 and older, there's what's called a catch-up contribution, where it allows you to contribute more to those accounts. And the catch-up contribution was $6,500. Now it's going to $7,500. That's on top of the increased $22,000 that is available now in the 401k and 403b. If you have a simple IRA, that's going from $14,000 to $15,000. Now, if you're self-employed and you have a SEP IRA or solo 401k, those increased as well. The SEP IRA went from $61,000 to $66,000, so you can contribute $5,000 more in 2023 than you could last year. The solo 401k is also at $66,000, but you also have that catch-up as well of the $7,500 increase. Now let's look at the Roth IRA, and this is typically outside your employee-sponsored retirement plan that the 401k and the 403b are. But if you have an individual Roth IRA, that has been $6,000 a year you can contribute to each one, and now it's going up to $6,500. Now for this, they didn't increase the catch-up. It's still at $1,000. So now if you're 50 and older, you can contribute $7,500 to that Roth IRA instead of $7,000. And they did, for the Roth IRA, increase the max income limits that you can have. So if you're single and you made $130,000 to $153,000, there is a reduced contribution that you can have. If you make over $153,000 a year, you can't contribute to a Roth IRA at all. Now, if you're married and you file jointly, that's $218,000 to $228,000. If you're in that range, you have a reduced contribution that you can put into your Roth IRA. If you make over $228,000, you can't contribute to a Roth IRA at all for 2023. So check those out. If maybe you were last year over the limit, you may fall into that reduced amount and may be able to contribute a little bit. So make sure you check that out. Now I want to spend the rest of this time talking about the actual investments in those accounts. How to look at your 401k, how to know what you've contributed to, how to look and make choices going forward. If you have a Roth IRA, how to look and make the best decisions for this. Now, this is not financial advice. I'm not telling you to pick certain ones. I will give you examples, but this is going to be based on your risk factor that you're willing to risk, and then your age. How far are you from retirement? All those are going to be very personal to you, that you have to make those decisions for yourself. Now, for a vast majority of people, they are primarily or solely in their 401k, and that's where all their retirement is based. So if you're in a 401k or the 403b, they're the same, you have a very limited options. You only have about a dozen different mutual funds to invest in, and probably 3/4 of those are retirement dated funds. And so if you don't pick anything, it defaults generally to that retirement date fund, like when you started the company, and it's probably going to be based off your age. And it's going to pick a retirement date fund, and that date was going to be kind of the estimate date that you're going to retire. And it is a blend or mixture of different ETFs and mutual funds that are going to be large cap companies. There's going to be a few that are bond related. And as you get closer and closer to that retirement date, this fund is going to automatically convert more and more of these to more bond heavy. And so these are mutual funds, so they're going to be actively managed by someone. So these are also going to have a higher expense ratio that we're going to talk about in a minute. But for someone that doesn't want to think about it and just wants to pick that is an option. I don't think it's the best option. There's always another option in there for a custom portfolio where you can pick the percentage of those a dozen or so accounts. And here's what I want you to look at. There's 3 or 4 things you need to pay attention to if this is what you're going to do. You need to look at, number 1, their return. They should give you like a 1, 3, 5, and 10 year return. Now, I want you to focus on the 5 and 10 years, especially ignore the 1 and 3 because the last 3 years have been kind of wild in the market. So you're not going to get a good picture of what this fund is capable of. But if you look at the 5-year and specifically the 10-year, you can see how they've consistently returned. And so you can find funds in your company sponsored account that are going to be at or above the 10%, and you can usually find 2 or 3. And typically these are going to be the large, mid, and small cap funds. That is where I put 70 to 80% of my retirement into those 3 funds. I do put a small amount in the retirement account or the retirement date fund. So I usually have 4 different funds that I contribute to. I'm heavy in the large and mid cap. But the other thing you want to look at on top of the return percentage is you want to look at the expense ratio. And that expense ratio is based off of the cost that you're going to pay, the fees that you're going to pay to the broker for managing these funds. And you can see them up close to 1% or even above. And 1% doesn't sound like much, but 1% can be a lot. All right, let's look at an example of this expense ratio. So let's say you invest $100,000 that says, according to the fund sheet, it has an expense ratio of 0.85%. So it's under 1%. So you're going to pay $850 to the fund's manager this year, and that will increase as your investment grows. But if the fund's value increases 10% annually for the next 10 years, your initial investment of $100,000 is now $260,000. That's a great return. But also over that 10 years, you're going to pay fees of almost $20,000. So if you can find something that's 0.08 or 0.05 or below, you're going to pay a substantial amount less in fees. So the expense ratio, because what that is that's money that's not going to be compounding in your account that's going to that fund manager. So you can find plenty that are around that 0.05 and below, and that's where the large, mid, and small cap funds are going to live, is in that range of around 0.05%. So not only do those typically have a higher rate of return, they also have a lower expense ratio. But the biggest thing that you need to do is, as you're researching these, make sure you know what the fund is, and then you can look and see what that fund is holding so you understand what you're truly investing into. Now, on top of your employee-sponsored 401k, if you also have your own individual Roth IRA, I want to go through a few things on this as well. For 90 to 95% of people, because the Roth IRA has the option to invest in the whole market, you can pick individual stocks. But for 95 or more percent of people, you still need to stick to ETFs, these exchange traded funds, which is a large group of stocks. It's going to give you a good diversification. You don't have to be as intentional and detailed in studying what these individual companies are doing because you're so diversified. But I want to walk through a few that, if you have a Roth, that are very beneficial to have in a Roth because of the tax advantage that this has. Money going into your Roth has already had taxes paid on it. And so the money that goes in, not only you get to draw tax-free, but it is going to grow tax-free. There's no taxes on the gain. So you want to look at, number 1, some growth-focused ETFs. And so that's going to be something like the QQQ, the SPYG. So those are tracking growth funds in the S&P 500. The QQQ tracks overall NASDAQ. And so those are tracking larger companies. And some of these are also going to pay a small dividend, which I'll talk about in a minute. But these are companies that are growth focused. And so as they're growing, as their stock price appreciates, you're not paying any gains on that when it comes time to draw these out. Now, the other option to look at is income focused ETFs. And these are going to be your dividend funds. So there's going to be a lot of ETFs that are focused on dividend paying companies. And a lot of these companies are paying dividends monthly, quarterly, annually. And if you have dividend paying companies that pay outside of a Roth, outside of a tax advantaged account, a majority of dividends are paid or are taxed as ordinary income. And so if they're in your Roth IRA, you're getting this income tax free. And so two very basic dividend ETFs for I want you to look into. One is VYM. That's one I personally hold. That is a high dividend ETF. And the other one is going to be DGRO, and that is a dividend growth focus. So these are companies that pay a dividend for one, and they're still focused on growing and growing their dividend. So in the long run, if you have a long runway ahead of you for your retirement accounts, those are two good ones that I want you to go look at and research and help make that decision. One other income-focused account, there are different REITs, and there are REIT ETFs. A REIT is a real estate investment trust, and a REIT invests majority in real estate or finances real estate as their income source. And so you're going to find things from all categories. From there are mortgage REITs, there are large property REITs. You think that ones that own all your big box stores properties. You have hotel REITs. You have that are hospitality REITs. You have some that are focused on resorts and things like that. So there are REITs that cover every gamut of real estate. You have apartments and things like that. And so you can find you some great REIT ETFs that hold a few different types of REITs that are, but what's nice about REITs is they are special tax advantaged, where they have to pay out 90% of their gross income back to their shareholders. So these REITs are going to have a higher dividend percentage generally than your basic dividend income paying companies like your Home Depot, your Johnson & Johnson, your Microsofts, and other companies like that. And one REIT ETF that I really like is just a Vanguard Real Estate Index. It has a broad range of REITs. So if in your Roth IRA you have a REIT ETF, a high dividend ETF, and then something like the QQQ or the SPYG, something like that gives you 3 or 4 funds that give you a broad diversification of companies that is very simple for you to understand, very simple for you to track and consistently add money to, that will take very little time. So whatever it is, whether it's your 401k, whether your whatever employee sponsored retirement account you have, or your individual IRA or your Roth IRA, the biggest thing I want you to do is to make sure you know what your money is doing in those accounts. I've heard horror stories of people that donated for years into their 401k or to their Roth, but it went in as cash because they never set the contribution. And so their money went in, great, you just created a savings account and you didn't invest anything. So understand what your money's invested in, what your future paychecks are going to, and that you understand those accounts. Make sure you maximize. This is huge. Make sure you maximize your employer contribution. That's free money. I have a whole nother video on dividends if you want to dive into that a little more, because I'm a huge fan of those. But make sure you're maxing first and foremost that employee-sponsored retirement, that you're getting that free money. Then go to create a Roth and start investing in that Roth IRA. Once you max the Roth, then go back to your employee-sponsored retirement account, whatever that is, and start increasing above that percentage that they will match. That is your priority. Do this in 2023, and you will maximize your retirement. You will maximize your ability to hit your financial goals. You'll be able to hit the retirement life that you desire, but you have to be intentional. Hope you guys enjoyed this. Make sure you go back, do the things we've talked about, grow your knowledge of your finances, and you guys will have an incredible 2023, and I'll see you on the next one.